Okay, the Q&A, where's the Q&A?
Yeah.
Oh, the Q&A box is gone. Okay. Where? Okay, okay. Where's the question? Okay. How do I drag it out? Can somebody help me drag it out? Sorry. Okay. Am I unmuted or? It's already unmuted. Okay, let's start it. Thanks for joining everyone and good evening. Today is our 7th installment for the CIO series, where we share our worldviews and investment opportunities. I have not been with the firm for very long, just another personal introduction or reintroduction. My name is Wang, CIO of Wealth Management. For the past 27 years, I have a unique background of investing in US, China, and other global markets. I have worked for US, European, and Chinese firms, now working for UOB Kay Hian, a Singapore company. And as a global investor, I spent a lot of time studying globalization, and I also have the advantage of being a multicultural person to begin with on the topic of globalization. Of course, now we talk about deglobalization, the reverse of that trend. And also, most part of my career, I was a tech analyst and a tech investor. Studying tech is studying change. So over the years, I've developed my own philosophy about how technological changes work and what are the investment implications. Hopefully, we will get the chance to share that with you over the next few sessions. For today, I want to talk about a few things. There's one very important key takeaway is that I feel this world is becoming more complicated. Thus, the title of today's presentation is about anything but normal. But if you look at the market, it's becoming very childish. I'll give you several examples. 2 quarters ago, when Tesla reported earnings, when Elon Musk just mentioned the word economy weak, the stock collapsed. One word. Bitcoin recently drove on one thing and one thing only. That was the spot ETF. And then if you look at whether it's the bond market or equity market, the volatility, where that come from, people tend to focus on just 1 or 2 data points on inflation, not having a more complete picture of what's driving this inflation, what are the different components, and what are the reasons for the inflation. So it is what it is. I'm not necessarily saying the market is wrong. I'm just saying that we have to live with that. We have a lot of complicated factors that we need to consider on one hand. On the other hand, the market is taking only one at a time and tend to have these knee-jerk reactions like what we had on Friday. In some cases, no news. The stock market could be down 5-6% and single stock could be down 10-20%. I don't think this phenomenon is going to go away. So let's prepare for that, and we can also talk about later how we deal with this. On a short-term basis, a lot of questions on where are we going with the U.S. market. My view is that it's not overvalued, but it's probably overbought. That's why we have some corrections, and this correction will probably continue for some time. But the long-term trend is not broken because we are now looking at AI as the main driver for the US market. As long as AI is intact, which we think, the market trend is not broken, long-term trend. And in terms of stocks, you're right. You know, we're not looking at a broad spectrum of stocks. Historically, for the past 2 years, it's been just a few stocks driving the US market. Also, this is not going to change. I will demonstrate later why Magnificent 7 will continue to dominate. In terms of asset allocation, we began this year with overweight bond and underweight equity. That's not changing. In terms of equity allocation, what we've been doing is starting second quarter, we cut more US equity and buy that into China. So US equity allocation is down from 25% to 20%, and China we added from 5% to 8% in the total portfolio. And I want to talk about later why the sector strategy doesn't work anymore in today's world. And what makes sense is really a thematic investment. So you have to really think about themes and what are the stocks underneath each theme, like AI or deglobalization or supply chain shocks. And for some of you already know that we proposed a barbell strategy for stock picking earlier this year, which is essentially staples and energy on one end of the barbell, and on the other end, you have high-tech innovation like AI. And for our core recommendations, it's on page 19 of this presentation, and it's also in our monthly report every month. Okay, so the question here is where we are going with the US market. Will the market continue to go up? I'm sure everybody wants to know. And one thing psychologically I want to point out that these crashes, the bad time tend to stick in your memory. And it's a human nature. It's psychology. In reality, in the US market, the crashes for the past 20, 30 years, it's actually not that long, right? So this table lists from all the way from 2009 to today, how much correction we had on S&P and how long did it last. In the worst case, it lasted 280 trading days. What is that? Maybe just over a year. But don't forget, we have multi-year bull runs. Nobody was complaining when the market was going up almost every year, and then suddenly the market's down one day for 10% or 1 week for whatever, and you have a short period of 10 to 20 days of so-called technical correction, and people freaked out. So again, this is human nature. I think psychologically wise, biological wise, human beings are just more sensitive to risks, to fear, than to the other side. And there's biological reason for that. So reality is, don't over worry about these so-called technical correction. As I was saying, last Friday was scary, felt like the end of the world, but all previous corrections on this table, if you look back, try to feel what you felt at that time, it's the same feeling. But if you're able to pick some good stocks, do some proper risk management, and hopefully follow some of our good advice and make money for you and for your clients. So that is the reality. And the two other very important truths about the US market or the global equity market is that given enough time, they always give you positive returns. So maybe you're looking for a 1 week horizon, 1 month, that is just not reasonable to guarantee a positive return. And this is very typical long-term investing talk. I'm sure you hear this from a lot of other people. And one other thing is that if the nature, the truth about investing is beat the inflation, I only know one asset class can beat inflation consistently. That is equity. Or you can add real estate, but real estate equity tend to be similar. Not gold, not bond, but equity. It's guaranteed to beat inflation over the long term. And then back to what I was saying, in terms of market trend, we're only at the beginning of the AI. The AI itself is not without risk. I can talk about what the AI risk is, but the risk is small at this point. And I think that the AI-driven market rally, it is only at the beginning, if you give yourself more time. The next question is the market overvalued? Or does the valuation even matter? So there are a lot of arguments on this. If you follow someone like Apollo Management, that's a very well-respected hedge fund, they look at the top 10 companies within S&P, and as well as excluding the top 10, and as well as all S&P overall, and look at the market valuation. They say, wow, it looks like it's more expensive than 2000. But let me point out some very interesting fact, and this is really relevant. People forget how small Magnificent Seven was in 2000. Only 4 of the 7 stocks were existent in 2000. Apple, NVIDIA, Microsoft, and Amazon. Only 4 companies were even around in 2000, okay? So some company not even included in S&P 500, right? Guess what's the biggest company back then? Obviously, it's Microsoft, 150 billion in market cap in 2000, which today sounds like a rounding error because Microsoft, Garrick, is already what, 2 trillion? Yeah, look it up. So Microsoft's already the largest market cap in the world. Back then it was only 150 billion. And then that's already the largest, okay? NVIDIA was 2.4 billion US dollar, 2.4 billion US dollars. That is micro cap, not even small cap. That could be micro cap in today's environment. Yeah, almost $3 trillion. But that's irrelevant now because back then Microsoft was small. All these companies, really, Apple, number 2 company in the world, it was only $4.3 billion. Amazon, 5.5 billion US dollars. What I'm trying to get at is when you want to compare the valuation now versus the market, a lot of the comparison not relevant. If you want to do apples comparison, according to this table, Microsoft is cheaper than in 2000. And Microsoft has a better balance sheet, has better cash flow, has better fundamentals, has stronger market position than 2000, but cheaper valuation. And on average also, if you compare the Magnificent Seven valuation versus the top technology companies at the time, is also much lower. And we actually did this study in our latest NVIDIA report where we compared the run of Qualcomm, a company that's very similar to NVIDIA during the internet bubble, over the same 300 trading days, which is for Qualcomm was from December 1998 to January 2000, Qualcomm was up 4,000, what is this? 40 times, right? Up 3,000%, up 40 times. Versus NVIDIA was up only 360%. Even though both numbers are very crazy, but just to show you that internet bubble was even crazier. So again, I don't think the market is that overvalued for people who were used to paying 15, 20 times price to earning multiple. Definitely this is expensive, but not as crazy as the internet bubble. And valuation today is subjected to a lot of questions because, again, I can spend an hour talk about the traditional valuation metrics. I don't think it works today for the high-tech company because we don't know how big this AI opportunity is. And here's another qualitative reasons why that we're not living in a bubble. And my personal story, I hope not to drag this too long, was that when I was a tech analyst during the internet bubble, we have these young 20-something, didn't even graduate college, and no business experience, no money, come to our conference wearing shorts and T-shirts and teaching us how to make money in the internet, in e-commerce, teaching us what is the internet. Of course, a lot of them failed. But look at what's around today. I'm just randomly picked some of the biggest companies. Look at on the left. the well-capitalized, cash-rich, some of these companies are more cash than a single country, right? Billion, we're talking about billions, not millions anymore. And almost all of them are in net cash positions. On the right-hand side, these are the founders. The youngest is Mark Zuckerberg. He's 39 years old. No 20-something, no experience, kind of just building on dreams. And these people do real things and doing realistic planning and work around AI. So that's another reason I don't think it's such a bubble when you have deep-pocketed companies, smart companies, and deep-pocketed individuals, and very smart individuals, very experienced individuals. Not to mention AMD, Ms. Su, she's in the 60s, SMCI, the founder, Mr. Liang, he's almost 70s. I think he's over 70 years old. So that's another anecdotal evidence why we don't think this is a bubble and why we think this thing will stick. Okay, it's not just the 2-3 years bubble burst. Okay, switching channels. I talked about asset allocation earlier. When we talk about asset allocation, we don't just give you the allocation. We present you an all ETF cross-asset portfolio based on our asset allocation. And this is what we had in the first quarter of this year. Obviously, overweighting bond hurted us. Our original thinking was that, you know, the Fed's going to cut rates and there'll be a lot of rate cuts and bond will benefit, but it didn't happen. And one of the biggest losses come from something called a 20-year plus Treasury bond ETF, TLT. We positioned this as a hedge against a potential US hard landing. Back then, the thinking was in third quarter, we saw a significant decline in consumer spending. A lot of listed companies from Walmart to Coca-Cola to Home Depot were talking about slowing down US consumption, but it turned out in fourth quarter, first quarter, the US consumer has more resilience, the economy is better than expected. Obviously, that trade doesn't make as much sense. The TLT trade, it should benefit if the US economy weakens, the TLT long-term yield should go up. Sorry, the long-term yield should come down and the price will go up, but it didn't happen. So that was a mistake. And also, like I said, we underweighted in equity. That's also, in hindsight, a mistake. But we did make money from stock picks like NVIDIA, which is up a lot in first quarter. One thing we did right on asset allocation was gold. And if you want to know more about why we like gold, please refer to our February Wealth Monthly. It's not only about geopolitical risk, it's also about people's frustration with central banks around the world, not just the Fed. Everywhere, the central banks are failing to contain inflation and give something that's adequate in terms of the economic growth. So gold, we made the right call, a good call. Recently, also gone up a lot more. What changes we're making is, I don't think in the current environment I was saying, the market has a lot of knee-jerk reactions. We go from higher for longer to 6 rate cuts to 3 rate cuts and now no rate cuts in what? Just 3-4 months. And these things change every day, trust me. So we want to give ourselves more time. Okay, so this is the time that you don't want to go crazy like the market and change your view every day. We believe that there's still a chance for the Fed to cut rate because we're not fully convinced the inflation is running wild, right? There's certainly signs that most parts of the components of the inflation is coming down. We have 1 or 2 components that's really going up. And you should see this, by the way, in the month-end PCE inflation, where you see a significant slowdown, because the way they calculate the insurance costs is different from CPI. So the numbers will reflect otherwise. So no change in overweight bond versus underweight equity, as allocation. But we are cutting the TLT. I was just saying the TLT was supposed to hedge against the hard landing. If the hard landing loss risk is lower, then no need to have that much. In the equity side, we switched something from US to China. And China, I've not talked about too much about today. Let me give you some words on that. The reason we increasingly like China in the second quarter is that, things are maybe not as bad as you think. At least not as bad as what the Western media portrays. Some of you may have been to China. Some of you never been to China since COVID. But if you've been to China, you know what I mean. It's not as hot as the US economy, but it's not as bad as what the consensus is. And if you look at last year's growth, nominally, US GDP was up 6%, China was up only 4%, right? 4.6%. But if you adjust it for the inflation or the deflator, the real GDP growth, that's a measure, a more accurate measure of GDP in some sense, China is still higher. In fact, China is still growing at twice the size of the US rate. Okay. And number two issue is that a lot of people worry about real estate, but last year was a significant turning point where real estate had the negative contribution to China GDP growth for the first time. So you can see China, for good or bad, has successfully decoupled from real estate. And this is also evident in the stock market reaction this year. In February, Chinese real estate sales were down another 60%, but Chinese stock market was up, not down. And you can monitor this on a weekly, daily basis. Every time there's more bad news out of real estate, people are getting numb towards it. The market barely reacts to it. And the part of the reason that maybe the market increasingly see other drivers, right, such as exports. Of course, exports last year was down because of a high base, and also US dollar terms, we have some RMB depreciation. But export over the medium to long term remain a bright spot in China. First quarter export added about 0.8% growth to the China GDP growth, which is very significant. And I don't want to spend too much time talking about this. This may take another half an hour, but there's a structural changes now going on with Chinese exports. That's the reason we think this more sustainable, more resilient, and will bring more value add to the Chinese GDP, because we're no longer in the business of only making textiles, shoes, and toys and furniture. Sorry, these charts in Chinese, but if you look at the blue portion of the chart, it tells you the traditional stuff that China used to make is low value add, but that's no longer the case. We increasingly make a lot of advanced products like electric vehicles. And we recently wrote a report on why it's no random that Chinese export is dominating the world in terms of EVs, in terms of solar equipment, in terms of medical electronics, in terms of consumer electronics, cell phones, and everything. And most people associate this with policy. But we listed at least 10 or 9 other sustainable advantages China has with these type of things. And if you're interested, we can have a separate session on it. It's certainly, like I said, a bright spot of the Chinese economy. The war, the so-called trade war with China on these products is already lost. And I don't care how much tariffs, how many artificial barriers people try to put in place, is not going to undermine China's advantages, okay? And also to be clear, we are talking about the advanced manufacturing the low-tech space, the industrial tech space. We're not talking about AI semiconductors. In those areas, China still have no chance. And one more thing to be optimistic is, as I was saying, that real estate sales are down, and export may be down and up, and there's a base effect. March exports actually was disappointing again because we have a high base in March, not because of Chinese exports are slowing down. One thing really important to cross-check is the U.S. consumer spending, whether it's the PCE spending or U.S. retail sales continue to beat expectations. So Chinese exports should do well. And into June, July, and we said this numerous times internally, I hope you get the chance to listen to it, that we were heading to a low base, an easy comp for Chinese macro data in June, July for real estate, for CPI, and for exports. So that will hopefully improve the market sentiment. And our advice right now is to buy on dips and just don't be overly pessimistic about China in the near term until the June and July numbers show up or people begin to pricing the June and July expectations. Okay, enough on China. We are slightly positive on China, even though we have not given up on the US. And in terms of the sector strategy, so I talk about asset allocation, I talk about macro, I talk about the big changes in the world we should capitalize on. Naturally, the next thing we talk about is sector strategy, but I'm not going to get into that discussion. I also suggest you, if possible, try not to look at the market from a sector standpoint, because the sector is so out of date and it's so irrelevant today. And look at the M7 as an example. They all work with each other. Some of the M7 companies, they directly compete with each other. But our rocket scientists, GICS sector classification broke them down into 3 sectors. And really blows my mind, why would they put Amazon, Garrick, right, into consumer, discretionary, and Amazon is a retailer. You do know what percentage of Amazon's, I have the number, 54% of Amazon's profits are from Azure, no, sorry, AWS, I'm confused, which is the cloud computing business. This is not a retailer, my friend. This is an AI computing company. And in the future, I bet 70% of the profits were from AI, from AWS and cloud computing. So clearly, whoever does this sector classification is either lazy or asleep on this job. Okay? So forget about that. And Tesla too. If you buy Tesla just for EV company, for auto company, you should never buy Tesla. Tesla has never traded on an EV company value. Tesla has always traded well above the auto business value, right? It's never about the EV itself. Of course, the EV is important as a cash cow, as earnings growth, as the base, but you don't buy Tesla for EVs. You buy Tesla for something else that other great technologies that Elon Musk want to launch into, right? Okay, this can go on and on. So what's the alternative solution? I increasingly think that all of us should look at everything from a thematic standpoint. Forget about the sectors. Forget about all the traditional way of thinking, right? So one theme we're looking at today is AI, and specifically the AI energy consumption. One example is today, globally, data centers account for 3% of the global electricity usage. But that is expected to double in 5 years. And another estimate says in the US, it's 5% of electricity usage from AI data centers or data centers in general. In 5 years, it could be over 20%. That's four times growth. Okay, so this is what we are talking about here, which is what is the investment implication, the thematic investment implication opportunity from AI. It's not just the M7. It's not just technology. It's not just semiconductors. It could be power equipment, could be utility companies, could be natural gas, which is the main source of electricity for the US. Oh, you see how that works, right? So you really have to take a holistic view. And I guarantee you, no one except UOB Kay Hian is helping you think about this in this way. Because honestly, we're the only firm can do it, because we don't silo our analysts into different sectors, say, you're a utility analyst, you don't talk to tech analysts. All of our analysts talk to each other under our management leadership. We are the only place you can get that kind of research. Either you don't want it, you come to us. Thematic research, AI, is not just about technology. It's about so many other sectors, and the sectors are already failing us, by the way. Okay, I know I'm taking a lot of time talking about it. Let me give you a few more minutes. I'll open up for Q&A. Talk about stock picking. So in terms of stock picking, also let me reiterate what we are suggesting. A barbell approach, two hands. On one hand, you have defensive plays. On the other hand, you have offensive plays. You combine it into something that's ideal. On the left-hand side, when you say defense, normally what we mean is low risk, low return. On the right-hand side is high risk, high return. And what does that mean? In the middle, you have median risk, median return, right? No, you're wrong. The stuff in the median, in the middle, is not necessarily median risk. It's median return, but it's not median risk. I'll give you one example. The banks, compared to high tech, the banks, it's going to be median return. Of course, banks in a certain year, if the banks collapsed, and it will rebound 50%, no problem. Normal years, banks not going to outperform technology, right? It's a median term return. But the bank's risk is very high in our view. Again, more on that later. Don't have time to talk about today. Many other industries now facing the threats from AI. So the risk is not low. The risk is high, but the return is median. That's why stuff in the middle is just not attractive to us. It's optional. And like I said, because we have additional connection between AI and energy, so we like to invest in both of them at the same time. So on the left-hand side, we have the defensive plays, staples plus energy, like Walmart or Occidental, which is an oil company owned by Warren Buffett. On the right-hand side is Microsoft, NVIDIA, our top two picks right now for AI innovation. Very soon, we're going to add in other names. I mentioned earlier, from a thematic standpoint, it's not just semiconductor, it's not just about cloud computing, but there'll be a lot more that's outside the box and hopefully leading the market as opposed to try to be a follower. Okay, I'm going to stop here. I feel like I already take a lot of time talking, and I'd like to open up for Q&As. If you have a question, please use the chat box to type the question, so maybe I can answer it in the order they come. Could you ask Charlotte to come in? I lost the Q&A box again. You just walk over the next room. Yes. They're outside. If you have a question, please use the chat box to type a question. While we're waiting, we got about 10-15 minutes for more questions. But while we're waiting, let me also introduce to our team. We now have a 5-person team leading the wealth management research, supported by our institutional research, which is over 100-person team. I lead the team, and followed by Paul Davino, he's our US strategist. He also does very successful monthly webcasts on the US market. Please sign up if you're interested in that. His focus is really on the global macro, US macro, and some US stocks. Eugene, based in Singapore, he helps us cover the Asia, especially the Southeast Asian markets. And I was saying earlier, in terms of decoupling from China, deglobalization trend, I think Southeast Asia could be a beneficiary. Derek, who just joined us last week, is our US and global tech analyst. And he's the guy that could help us pick more US stocks, especially AI, thematic AI trend. Our publication, here's a list of our publications. And if you have not signed up, I strongly recommend you sign up for this. And then for certain publications, it's for professional investors only, so there might be a constraint there that you may not be able to sign up. And our core recommendation, you can always find this in our Wealth Monthly, which is published every month. Luckily, our first quarter Wealth Monthly, first quarter US stock picks were up 19% in the first quarter, which is I thought was pretty extraordinary and pretty much overrun. That's why on April 15th, we published the Wealth Monthly, talk about how we need to be cautious. And 4 days later, market crashed, right? So a lot of cases, you can see that we don't just follow the market. We always try to keep a cool head and try to understand how things are going from a fundamental standpoint and try to match that fundamental change to market performance and try to draw a conclusion on investment and trading. Okay, I will answer some questions here. There's a question about will the session be recorded? Yes, the session will be recorded. Now, whether that will be put on a portal, we probably need to check with the compliance on that. I will let the marketing team to answer that later. Were you advised about SGX market with stocks that leverage on themes? Yes, I think, I mentioned earlier that there are a lot of interesting Southeast Asian opportunities. In some cases, it might be private equity, not necessarily in the public market space, that may benefit from the ongoing macro changes. One thing we wrote about recently, by the way, is this visa-free travel between China and Singapore, Malaysia, Thailand. And suddenly, all three countries become the top destinations for Chinese tourists. And that's by our estimate, it's at least a $100 billion industry. It's no longer Japan or Australia. So we're looking to candidates for that type of trend. But unfortunately, for the large cap liquid opportunities, we don't see a lot of viable plays. That's the challenge of Southeast Asia. A lot of growth, but not enough investable listed companies. Why do we think the banks that risk reward are not good? It just holistically, that's a really good question, by the way. Holistically, if you think about the bank's business model, it's highly leveraged, right? If you look at the balance sheet, if you look at the Tier 1 ratio, if it's 12%, that means they're leveraging up 1 to 10 or 1 to 9. So that's the inherent, unless banks change the model, I don't think they will change. Unless banks change the model, that will continue to entail a lot of risks. Because in certain interest rate environment, any highly leveraged business was subject to risk. And Chinese real estate already give you that example. You can say Chinese real estate's case, it's the Chinese policy that broke Evergrande. But what about the US interest rate? Does that have any impact on that? I think it has a lot to do with that too. Again, look at Silicon Valley Bank. The holistic, from the bottom-up standpoint, the failure of SVB is about mismanagement, right? Misexecution. But from the top-down angle, it has everything to do with the U.S. interest rate. Because of rate increase, because the treasury yield increase, the price drop impact the market, impact their solvency or the chain reaction, right? So how do we pinpoint exactly this interest rate volatility impact all the loans? And impossible, because you're looking at a multi-trillion-dollar question. And the problem is the banks themselves don't even know. Do you think really the bank's manager really know what is the exposure, say, to student loans, the real exposure, or to say auto loans, to Credit Suisse, right? All these things are either intransparent or incalculable or unmanageable, right? They're so large, so sophisticated, right? There's no way we can really match one-to-one. Okay, this thing happened, path dependent, this thing will happen, and that will happen. So we cannot really get into too much details into what problem will emerge. I cannot predict which bank will be the problem, but I just know it will be a problem, right? It's like if you have a COVID, right, and your immune system weakened. If your immune system weakened, are you more susceptible to catch cold or flu or maybe other transmittable diseases? I cannot predict that. But I just know your immune system has been weakened. You're going to catch something. And some of the things may kill you. You know, these infections can kill you because your immune system is weakened. That's exactly what's happening with the bank system. Becomes so big, so large, so global, so sophisticated and opaque, their immune system has been significantly impaired. Okay, that's a very long-winded answer. I apologize for that. And why do we think, sorry, the font size is really small. Why do we think, I'm missing the question here. So we got the risk reward question. There's a question on Japan market crash. If weakened beyond the 150, I think there's a question about the weakened currency impact on Japanese, weakened currency on the Japanese economy. I think it's a real concern. I don't know enough about the Japanese economy to say this. The reason, by the way, our asset allocation does not include Japan is because of the uncertainty on the currency. And we know that despite the capital inflow, the currency continued to weaken and also the economy continued to weaken. What sign would you look for imminent US market correction of more than 20%? That's also a good question. What sign would we? Unfortunately, the way that today's market work is no longer say XYZ happened and the market crashes. Most times, or sometimes at least, the market react ahead of the news. So I give you the bond market, for example. It's been down a lot by the volatility of the bond, right? The bonds usually don't move, but if you look at first quarter, the bond had one of the worst returns historically. And you can say, or I believe, that the bond is already pricing a lot of the uncertainty with the rate cuts, or may already pricing only one rate cut or no rate cuts. So when the Fed eventually announcing no rate cut, the bond may very well do fine, right? So this fundamental change, and I hope you're asking about fundamental side. This fundamental change and market change is not always one-to-one. That is my worry. So the market could look at last Friday, there's no news on AI. Okay, in hindsight, people say, okay, this reason, that's the reason. but it's all in hindsight, okay? I don't think there's a real reason why would NVIDIA down 10%. But maybe it's reflective of what's going to happen with NVIDIA fundamentally later, you see, right? We can really, the cause effect sometimes is not that obvious. It's not always say fundamental events happen and the market corrects. Sometimes the market corrects beforehand or people are pricing in some fundamental risk already. So I'm afraid that this 20%, it may happen without warning. However, if you look at technical analysis, in the current bull run, since November 2022, the reason we picked November 2022 was that was a GPT launch, right? For the 1 year half bull run on S&P has never had a drawdown of more than 8%. Of more than 8%. So technically, if S&P has a drawdown of more than 8%, then it's likely to go for another 20%, for 20%, another 12%, right? That makes sense? If it goes down for more than 8%, there could be another 12% waiting for you because that's how the 20% may happen. What that means is if S&P drawdown breaches below 8%, the current bull trend is over. What is your view on alternative private credit, private equity? No view whatsoever. I only focus on public investments. HSBC is still a good bank to hold. I don't know anything about HSBC. My advice is try not to waste too much time on the banks. What are you getting out of the banks? How much return are you expecting on the banks? 30% return? 20% return? Think about, for the same amount of return in banks, can you reconstruct that? Buying Berkshire Hathaway plus a high-tech, high-risk AI play. Okay, if you think that's too risky, by 20% in the AI play, by 80% in Berkshire Hathaway, I'm sure you're going to beat any bank's return. There's no growth in banks. There's no positive surprise in banks today. Tell me one positive surprise that could come out of the banks, other than the stock market correlation. Yes, there is, okay? But that's just correlation, right? Morgan Stanley did well because the market did well. The investment banking did well. The wealth management did well because what? The market did well. That's the beta, right? But the market didn't do well. If the market has volatility, what do we have for the banks? I just don't see, I'm sorry if I offend anyone on this call, I just don't see what value bank presents to us in today's environment. And I'm not even a believer in Bitcoin. If you talk to the Bitcoin crowd, they will be even more aggressive telling you how the banking system is failing a lot of people. Okay, in terms of services, in terms of the value add, in terms of risk management. Do you think really banks do good risk management? I don't think so. I really don't think so. Okay. This font is way too small. Can you get the IT people here? I told them already. I cannot possibly read this. Apologize. I wait a few minutes. Let me increase the font size. And yes. As big as possible, please. I lost the question window again. It's just so hard to use. Questions here. How do I expand the question? Oh, here it is. The font size cannot change, right?
Yeah.
It can change. I thought it changed before. Okay, it's okay. India market, is a question of India market appear not only, there's a question on India market, I cannot read the whole thing. We do not invest in India right now. Sorry, I have nothing to add on India. We are looking at it maybe next quarter or the second half of the year when we have figured out our bond versus equity and the US versus China allocation, we can add something in India. Right now, if you look at our emerging market allocation, there is a India element under emerging market ex-China ETF. Okay, we send that to you. There's an ETF called emerging market ex ETF. Impact on China, Hong Kong, and Trump election. Also, really good question. My 2 cents, I'm not a political expert. In fact, this is a perfect question for Paul Davino, my colleague. Unfortunately, he's not here, but please dial into his monthly webcast, and I'm sure he'd be happy to answer the question for you. I think it will be good for China that Trump got elected, because Trump tends to be very short-sighted and inconsistent in terms of policy execution. One of the things that China fears most since Biden's election, that the Democratic Party, they don't just say the word, they actually execute it. And they do this on a systematic, step-by-step basis that is very detrimental to China. Trump takes office, he's going to say, we're going to ramp up the duty, we're going to charge China this, we're going to charge China that. Look at what happened in 2018. He did the same thing. And in 2020, 2 years later, China's trade surplus to the US increased as part of the Trump trade war. Okay, so it's definitely not that effective in terms of try to containing China. So but what Trump will do is try to decouple from China. In terms of real financial impact and the market impact, I don't think it will be that negative. Okay, thank you for increasing the font size. And let's continue on a question and answer. 2 questions. Do you think AI is heading towards a bubble? I think I already answered that. I don't think it's a bubble. At least if you look at the valuation of the companies, NVIDIA trading at today now 30 times. It used to be 34 times, now 30 times price earnings for a company that's going to double the earnings growth this year and probably up another 30–40% earnings growth next year. Right? So you calculate what is the next year's price to earning ratio. It's going to be halved, right? So I don't think the valuation demanding, and I've never seen the bubble led by a bunch of old rich guys, okay? I already showed you Bill Gates, Steve Bezos. They were both very young when they were doing the internet bubble, but now they're become all rich guys. All rich guys don't start bubbles. They do smart things that make themselves more money. And let's get on with that. I don't think Bill Gates is stupid by investing. What was the news recently? Microsoft is investing $100 billion with ChatGPT. Sorry, OpenAI. I don't think Microsoft is stupid, is it? Okay, so this is not some 20-something young guy coming to UBS when I was a tech analyst in 2000, asking for $500 million for IPO. Okay, this is not it. Okay, and none of these people need money. I already showed you. All the tech companies are billions of dollars. They don't need your money. They don't even need VCs' money. And that's another thing for the VCs. There's no chance for startups anymore. The startups are competing with Microsoft, Amazon, and NVIDIA, and OpenAI, and Google, Facebook. And we're only 1 year into this thing, right? 1 year and a half into this thing, we already have gigantic players dominating the space. This is unlike any, if this is a bubble, this is not like any bubble I've seen. Give me another bubble when 1 year into the trend, all the big companies already dominated. No chance for small company, no chance for BS, no chance for, people try to raise money and try to grow into something new. The stocks are already there in front of our eyes. Okay, if this is, how would you eventually affect the Asian market for AI? Yes, Asian market, we will always be a second player. So Asia, assuming you China, right? So our China, so I mentioned earlier, we're positive on US market mainly because of AI. And we're not positive on China because of AI. Because China have no chance in AI. People say how many years are behind? 3 years behind. Yeah, it's more, okay, let's say by some calculation, we are 3 years behind the US. Asia, China, 3 years behind the US in terms of AI. But let me tell you, in AI years, 1 month is equivalent to half a year. There are breakthroughs in AI almost every month, right? So 1 to 6. So 3 year difference, it's 18 years different. It's like a dog year, right? For dogs, 1 year is for 7 years in human years. Yeah, 6 human years. Okay, same thing. Okay, so we're way behind, way behind, and not even mention the U.S. sanctions. So Asia will always be a secondary player. For example, our institutional research team, like a company called ASML PT Pacific. It's not ASML. Okay, it's not the European company. It's the Asian player in a very specific field selling to the packaging equipment. And these are not high-tech equipment, right? It's a very niche market, and okay, Asians can do. That's how we can do it, which is little things, low-tech things, but will be led by the nose by the US, unfortunately. So I don't expect any AI leaders out of China. Anyone coming to you say we are AI leader, they're lying to you. There's not even European, not even Japanese, not even Chinese, okay? So that's how, so Asian market is not going to be driven off AI, but might be driven off something else. Again, AI is not the only thing happening in the world. I mentioned earlier, on a barbell strategy, right? We have what? We have energy, we have food and staples. For Asia, I think it's extremely interesting as the world's largest market for that, right? Consumption upgrade or consumption downgrade. Either case, there will be opportunities for food. AI or not, Ukraine, Russia, Israel, Palestine, who cares? People still need to eat. People still need to wear clothes. It's just what kind of clothes they will buy. That's a different story. But that business is not going away, right? But a lot of other jobs and a lot of other business could be replaced by AI. That's what I try to say. Okay, let's move on. As allocation story, U.S. market, how you and your team weigh the U.S. election risk opportunity, maybe particularly how the Fed usually act in the election year. That's also a very good question by David. Thanks, David. And I forgot to mention, there's a lot of things to talk about, so I really skipped a lot of details. In terms of rate uncertainty, there's one thing we're quite certain, which is, and this is Paul Davino's input, the Fed is not going to do anything in September, October, ahead of the US election. That is the election year implication. Because the Fed is very wary of being perceived as politically connected or politically inclined to one of the two parties. If you look historically, the Fed has almost never done anything. They have done things in election years, but not in the election season. Okay, so September to October is very close to the November 8th election day. So I don't think the Fed would do anything. So the Fed, if they're going to cut rate or even raise rate, most likely either do now or they do in November. Because by November 8th, they can do it, right? November, December. So here we have a time frame issue, a time window issue for the Fed. Regardless of the uncertainty, we have a time window for now, all the way to September. That's 3 months, 6 to 4 months, right? For the Fed to act. Otherwise, the Fed will not act until at the end of year, essentially, right? So that is also the pressure. That's why the Fed is also under some pressure. That's why they tend to be more contradictory to each other, because they also a lot of pressure say, should we do anything before September or not? We don't know. Our view that the Fed will at least cut once, because the market expectation is there, still there. And from 0 to 1, the difference is 1. And from 1 to 2, the difference is 1. But the 0 to 1 difference is much bigger, right? At least you cut once versus, if you cut extra one time, that's not really needed. But the market really see that the Fed is moving in that direction. I think that's already good enough. And 2 more questions. Banking sector, not a good for investment. What do you think about insurance sector, AIA? Yes. Insurance, remember I said how complicated the banks are? The insurance is even more complicated. So think about all the issues I have with, and maybe just my personal ability. Again, please don't view this as the market consensus. So me as a person, I had really difficult time understanding the bank risk, taking the bank risk, not to mention the insurance risk. And when I invest in something, I want to understand what am I investing in? What kind of business am I invested in? For insurance, I cannot understand what business that is. Like what is the value of that? And how sustainable that is. Especially, by the way, insurance also a sector, even though I don't understand the details, is subject to AI risk, right? Whether it's the calculating the actuarial risk, the insurance premium, or the distribution of insurance products. All of these things will face, in the least case, disruption, right? In the worst case is destruction. So this disruptive technology like AI has destructive impacts. Let's admit it. And it's not good news for everybody. Last question and comments on the dollar trend, especially yuan's and the Xi's incentives to float. Yes, there seems to be some pressure to float the RMB. I agree with that, and how that will impact global asset allocation. That's also a really good question on currency. Somebody else mentioned the Japanese currency. We worry about that. And Chinese currency also worry about that. Until recently, okay, we did not worry too much about China's currency because we always believe in Chinese economy. Despite all the negative headlines about China, we also believe China has enough economic resilience, and the currency over the long term, short term, is really a reflection of the economic power of a country. And in China, I think, that is not going away. That's why we were confident in RMB. But that's the fundamental, right? Like a stock, there could be a lot of technical reasons. And your question really highlighted one of probably the non-fundamental, right? So maybe China politically, they wanted to devalue the currency. And this is a very recent view, and this is definitely not crazy, of another one-time devaluation. And we're not fully convinced on that view yet. I'm just presenting this view as a possibility, okay? This is not a UOB Kay Hian official view. As a possibility, as a scenario, and as a third-party view out there, suggesting in the very first short term, maybe by the end of this year, there could be a one-time devaluation of the currency. Why? Because China did that before. And with that dip before, it bought a lot of commodities like coal, like iron ore and gold and soybeans, right? So they keep piling up on the real goods, and then boom, a one-off devaluation or float, what you call the float, right? So China really didn't went to float, but it went from a strictly controlled to a more, I would say, a more relaxed trading range, right? That's what happened last time. Exactly the same thing is happening today. China is buying a record amount of coal, oil, gold, iron ore, and maybe preparing for some kind of a devaluation. Again, put in the context, we're not talking about China completely changing its currency system. So you're not going to be Like Mexico, where you have a depreciation, one-time depreciation of 10, 20%. That's not what I'm talking about. But a relaxation of the range, that's already big enough for China. I don't think the currency regime will change, right? The way it's to be probably a managed float or something, but the flow range will be much bigger. That's what I'm worried about. And that certainly has some reason for it, like I said, because you see these tremendous buying amounts of China in commodities. Okay, let's stop here, and thank you everyone for participating. Lots of good questions, and I hope to see you again next month. Bye-bye. I stopped recording already. 辛苦了. Hey, thanks for working so late. Thank you.